I'm Luke Timmerman, biotechnology journalist here at the Bio Investor Forum in San Francisco. With me today is John Chambers, Vice Chair at ROTH Capital Partners, prominent investment banker in the space. Thanks for being here.
Great. Thank you very much, Luke.
So, life's been pretpretty good as an investment banker in healthcare the past year or so. More than 100 companies have come public. What's this been like for you the last year to do this?
Well, it's been interesting, Luke. The start of the year, in particular this year, was very robust. We saw investors with 12 months of runway really looking to put capital to work in emerging names. They were making money and making a good return for the last 2.5 years. Really, if they played a basket of biotech stocks representing the index, looking for additional return in their portfolio, they were starting to look into small cap names as well as the most illiquid asset class, the IPO asset class, to garner excess return. So we saw, I think, funds flows very strongly into biotech funds, mutual funds towards the beginning of the year, and the return in the IPOs played out well so that it really kind of reinfused the marketplace. And we have had a biotech market that's been strong for almost 3 years with returns up about 35% per year, and having that long of a rally, that long sustained rally in biotech, which I haven't seen before in the last couple of decades, has really allowed companies that were too early 3 years ago all of a sudden to be IPO ready. And I think we saw the market sustain itself a little bit this year.
Now, I'm a bit embarrassed to say this, but about a year ago I said, enjoy this IPO rally while it lasts. There's a limited pool of IPO ready companies.
Yep.
So, but here we are a year later, it's still going. How much longer can it go?
Well, it's a great question, and I think what we've got going on is there are a couple dynamics in the marketplace. The IPO class that has gone out last year, they're starting to deliver milestones now, and investors are going to see their report card very soon in terms of their clinical progress. The other element is that we've had a very good M&A floor in the marketplace, where we've seen Intermune being recently acquired, Ambit recently acquired. So there's a lot of interest from an investor perspective in terms of who that next emerging company could be that will fit strategically, and not only strategically, but in their portfolio, and potentially have a strategic opportunity as an end result. So I think the market's going to continue to be buoyant. We're seeing right now, though, Luke, some pressure just due to general market conditions and volatility. There's pressure on IPO valuation. So the market swung a little bit in the recent past towards one where buyers are dictating terms a little bit more strongly. Values have been under pressure, but as long as they tend to perform in the aftermarket, and that is with a reduced IPO price, as long as they trade to a premium, we should see a healthy IPO market. And I think this brief period of turbulence, perhaps lasting through the end of the year, should bode well for a very healthy 2015.
You mentioned volatility, and of course this is one of the most risky industries there is, and you must think about this all the time. What are the risks that you're most worried about at the moment? Is it a phase 3 failure, unforeseen safety, or is it something like a pricing revolt on the part of payers or the government?
Right. I think the biggest issues that are confronting the sector right now that impact value over the longer term period are elements, reimbursement really being right at the top of the pyramid, and ensuring that there's good advocacy in Washington, and that reimbursement is a high focus for the executives within the sector. The second element is really trying to protect and ensure that IP is really scrutinized very thoroughly, but again, a window of IP is protected, so investors and companies will continue to deploy capital towards the space, understanding there's a period of time where they're going to be able to capture return. The market hasn't changed, though, in terms of the voracious appetite for capital. It's still, the unchanging rule is $1 billion to $1.3 billion to take a drug from the bench to the marketplace, and yeah, the attrition rate happens to be 90%, so we're living in a risky industry. But I think the positives, when you look at the potential for the drug companies and emerging pharma companies and biotechs to be a part of the Affordable Care Act solution down the road, as pricing becomes much more scrutinized in healthcare overall, as 25% of the GDP, I think these companies have the opportunity to really change the face of what that Affordable Care Act and longer term what the delivery of healthcare will look like.
Now, for a long time, this sector was dominated by very specialized investors, groups that had lots of MDs and PhDs on staff that just really roll up their sleeves. And then when the boom happened, we had an inflow of more generalist investors.
Absolutely.
Are you still seeing that interest among that group? Are they here to stay?
It's a great question, Luke. One of the things that we saw absolutely this year in that January timeframe was generalist players saw the significant returns over the past prior 2 years. As I said, 35 to 40%. They also were comforted in the fact that there was this strategic premium still being paid by buyers for companies at these appreciated levels. That gave a comfort to the generalist investor that they could invest in biotech really in a basket more than looking at specific names. I always caution the generalists that the basket approach is challenging because of the dynamics of a clinical setback or a positive, but in the case of a setback, it can drag down portfolio returns fairly markedly. The generalists got hurt a little bit in that March-April timeframe when we saw Gilead's interaction with Washington over pricing cause the market to drop across the board really in life sciences 15 to 25% based on the names you were seeing. I think that caused the generalists to back off, and we haven't seen their leadership in this current round of funding. We've seen the funding much more skewed towards pricing being determined by fundamental players, which I think is healthy at the end of the day. If you have that key opinion leader, very knowledgeable healthcare investor psyche driving pricing, I think we get to a very good spot in terms of rational pricing for financings.
Now, one last one. When you mentioned risk, you didn't mention FDA. Are you encouraged by what you're seeing out of the FDA?
The FDA has taken a much more accommodative stance over the last several years. That used to be my number one risk, about 5-6 years ago. I think we've seen with some of the breakthrough designations, things along those lines, which have created a process for companies to go down that's much more tangible. I think the FDA risk is really in the hands of at this point in the hands of the management team, as it should. They're paid to get out, design a trial in a very smart way, and I think having an accommodating FDA that's willing to provide good feedback along the way if the companies are willing to listen, that relationship is what creates the strength of the sector right now. So that risk to me has been mitigated.
All right. Thanks very much, John. Great to see you.
Excellent, Luke. Thank you very much.